Okay, so we're dealing with commissions here, so this can be a principal-agent type relationship. But we want to know for recording purposes, how would commission expense be reported for Travis Corporation? Right? Travis Corporation is the one that is hiring this agent to sell for commissions of 4% of sales. Okay, so the company has $2 million in sales for the current year, and they were sold for that commission. Okay, so at the end of the day, the $200,000 in salaries will not have to do with the total commission expense. That is a pure variable expense. So we're simply going to take the 4% and multiply it by the $2 million in total sales, which is going to give us an $80,000 commission expense that would be reported. Equivalents have a maturity of 3 months or less. All right, so in this question, we see that the company sold machinery with a 3-year service contract for a single payment of $40,000. Right, the fair value of the machinery was $35,000, but that's not going to be relevant. We're focused on the total payment price. Okay, so initially they recorded $40,000 as a debit to cash and a credit to sales revenue for the entire amount. Okay, so that is simply just not going to be the correct way to record this. Okay, because the total revenue amount is going to get recognized over a 3-year period. So if they're recognizing the entire $40,000 today as revenue, that means revenue is overstated. If revenue is overstated, net income is overstated. So that's why that is the correct answer choice. We have this performance obligation over the next 2 years. So liabilities would be understated, not overstated. Okay, so that would be incorrect for that reason. Assets wouldn't be overstated. This will be correctly stated because total cash was received for the $40,000. All right, so they still recorded cash the correct way. They're just not going to recognize the entire amount as service revenue. Right? Part of this would still be a performance obligation. All right, so that would be out. Changes would be made because net income, as we said, would be overstated. All right, so that's why this last answer choice would also be incorrect. Okay, so what we see here is that a retailer allows customers to have this right of return, so they can return the goods that were purchased within a 90-day period. The company estimates that 5% of the sales will be returned within the 90-day period. During the month, the company had sales of $200,000. So thinking back in our lecture, when we think about right of returns, we're immediately going to associate this with estimated revenues. So a company is going to recognize revenue for goods that are sold as the amount that the company expects to receive. Okay, so if in this case they expect to receive net of 5% on the $200,000 in sales, they actually expect to receive $190,000. They estimate that of the $200,000 in sales, $10,000 will be returned, and therefore they are not going to record the total gross amount when it's all said and done. But we do need to consider that estimate, and that's what's key. Okay, so after the $10,000 estimated amount is considered, the total net sales would be $190,000, and that's the amount that they expect to receive. Therefore, that's the amount that would be recorded as revenue. Okay, so we have a 3-year service type extended warranty. Okay, so specifically what we want to know is how much of this is going to get reported as unearned revenue at the end of year 2. All right, so what we do know is that this was sold on January 1st, year 1. We also know that warranty revenue is going to get recognized as it is earned, meaning that this is going to be considered unearned revenue on the balance sheet and will be recognized and reversed again as it is earned. All right, so if it's a 3-year service type warranty and it's worth $21,000, that means we're going to reverse $7,000 per year. So we're reversing $7,000 in year 1, $7,000 in year 2, and $7,000 in year 3. At the end of year 1, we're going to have $14,000 in unearned revenue that is yet to be earned. Okay, but they're asking for the amount of unearned revenue that is on the books at the end of year 2. At the end of year 2, another $7,000 will have been earned. So that means how much is left that is yet to be earned that remains on the balance sheet. That's going to be that final $7,000 amount. All right, so that's why this is the correct answer choice. Okay, so in this relationship, Bob Co. is selling goods to Drew Co. for $20,000 under the arrangement that Drew has an unlimited right to return the goods, and Drew's obligation is to pay Bob contingent on Drew's reselling of the goods. So this sounds like a consignment relationship to me. All right, we also know in past experiences, Drew resells 60% of the goods and returns 40%. We want to know what amount Bob would include as sales revenue on the income statement. All right, so thinking back on consignor-consignee relationships in our lecture, when is anything going to get recorded? Everything is getting recorded when the consignee makes the sale to a third-party customer. So this whole idea of Drew's expectation to make 60% sales and return 40% is just an irrelevant distractor. Okay, so none of this is going to get recorded as revenue because nothing here indicates that Drew has resold any of these goods. Okay, so the answer here would be 0.